Great, welcome back. So in this video we're going to look at the income statement, probably one of the simpler of the kind of financial or accounting documents that you need as an entrepreneur. And so the income statement basically just is a measure of your firm at any given point in time, based like on a year or a month, and it basically tells you are you making a profit or not, and where do a lot of your expenses lie. So the easiest number to figure out is revenue. And you'll notice on here, everything that is in blue is kind of a total number, and everything that is in purple is an indication that something is being deducted. It's a deduction or something that is detracting from your overall profit. So let's have a look. So we've got revenue. Let's say that I've got a real small firm, and in a month I make my revenue is $1,000. Okay, great. But in order to get that $1,000, I need to spend $400 on what is known as cost of goods sold. In other words, like raw material, labor, cost of facilities, all that stuff. So in order to get this $1,000, I need to spend $400 in cost of goods sold just to get there. Okay, that leaves me with a gross profit of $600. However, in order to continue making that gross profit, you've got to do a little bit of investment in the future of the business. So things like sales, general expenses, administrative expenses, you might need to spend $50. Okay? You might also need to spend $50 on marketing to make sure that your business continues to grow. Research and development, getting the coolest new ideas, another $50. And then of course depreciation and amortization. Depreciation we've talked about just a little bit. Again, think about driving like a car and you get into a car accident. Let's say you bought a brand new Tesla and it was $100,000. And let's say you've had that Tesla for 5 years. Well, the insurance company may only give you $40,000 if you've totaled the car, not the $100,000 you've paid, because the argument is, over time the car has less value because of wear and tear and all that kind of stuff. That's your depreciation. Amortization is like the same thing as depreciation, except it normally relates to intangibles like patents, copyrights, trademarks, ideas, and it basically kind of gives you some sort of an understanding of the value of your intellectual property, which also that's intellectual property depreciation. That's basically your amortization. So it gives you some idea of how valuable your patent, trademark, etc. is. So we've got 50 here. And once you subtract all these four, that leaves you with $400 in operating profit. And then from operating profit, you take $100 off, for example, from interest expense. That's interest that you're paying on a loan. And then, of course, another $100 that maybe you pay for taxes, and that leaves you with a net income of $200. So you can see how, even though you've got revenue, which may be very, very high, that's, in fact, in many cases, that's going to be your largest number, unless your firm is experiencing a loss. You get this pretty good-sized number, and it can dwindle down very, very quickly based on your expenses. Great. So we've just talked about a very simple income statement. In the next video, I'm going to explain the income statement in just a little bit more depth, but at least this gives you kind of the basics. As always, if you like this video, give me a thumbs up, subscribe, and comment down below. Great. I'll see you in the next lecture.